That was French. Why oui. It goes along with my scarf. We have Tony Lamia. He's going to be presenting here today, telling us about accounting. How many like accounting? 1, 2, 3, 4, 5. That's a fraction of the room. It's about 25, 30%, let's say, 35% of the room like accounting. Everybody needs a good accountant. Tony has taught accounting and business, and we are excited to have him here. Would you welcome him to 1 Million Cups?
Okay. Well, before we start my time, and merci beaucoup, Jason. Parlez-vous français? Can I do this before we start counting my time? Yes. Good. Because you got to have this. Otherwise, it doesn't work. There's a couple of them. Oh, yeah, I did. And by the way, Jason, when you asked about who likes accounting, you might have noticed I didn't raise my hand either. I don't like accounting any more than anybody else, mostly, because it's a pain in the neck. I've been teaching it since 2002 at Rock Valley College. I've been in business since before my birth date, since I'm only 39 years old. And I've done all kinds of things in small business, not the least of which is real estate management, office parks, shopping centers, apartment complexes, remodeling, kitchens, baths, room additions. I've been an instructor teaching QuickBooks, business law, business 101, other business classes, QuickBooks, both desktop and online. So been there, done that, and it does take, my goal in running a business is to, one, spend most of my time conducting my business and the least amount of time as possible worrying about bookkeeping, okay? So in all the time that I've been in small business, which has been many years, I had different secretaries that came and went. We get turnover like everybody does, right? And I had to figure out a way to teach my incoming secretary how to do the books as fast as I could figure out how to teach it. So I created a way of teaching bookkeeping different than college accounting. I call it the Genesis format. And why do people need to know about bookkeeping in small business? If you don't want to spend a lot of money to pay somebody to do your bookkeeping, and you want to keep it real simple, you have to know how to do it yourself. I'm going to tell you a story. You may not believe this, but I have been teaching QuickBooks for many years, right? And guess what I'm using at home? A pre-Windows DOS computer with an accounting program I bought from California 35 years ago. In addition, for my new business, if you will, which is on-site training for small business owners, I'm using an Excel spreadsheet. One spreadsheet that matches the Schedule C. I hand it to my CPA, he prepares my tax return, just like that. And over all the years I've been in business, I print out my balance sheet and income statement on 12/31 of each year, hand it to the CPA, prepares my tax returns. That's how I simplified it. Simplify is good. So the point is that you don't want to spend time bookkeeping. You want to spend time on your products and services and not wasting time on bookkeeping and not have to spend a lot of money to have somebody else do it. So I want you to learn only what you need to know. That's it. Keep it simple. The KISS principle is the best. So I have the Genesis format, and I can teach you debits and credits right now in just a few minutes. Okay? When you understand what's on that one sheet that you're looking at and the 4 rules I put on there, debits and credits mystery is gone. However, the thing that you have to train on once you understand what's on that sheet, you have to train on understanding in any particular transaction which accounts are involved and in what direction is the balance going. Is it increasing or decreasing? That's the training part. Once you understand which accounts are involved and which way the balance is going, you just look at my sheet, debits and credits are a snap. Just that fast. And debits don't mean minus, credits don't mean plus. Don't chase those arrows. Don't chase the plus and minus. You got to get rid of it. A debit can increase the balance of an account or decrease the balance of an account. And it's the same with a credit. Debit does not mean minus, credit does not mean plus. It's just that simple. Depends on the transaction, okay? So, why do we need to know debits and credits? Why can't we just do QuickBooks and let it all happen for us? And in fact, when you operate in QuickBooks and you enter an invoice, the debits and credits are done behind the scenes. You don't even see it. When you enter a bill, same thing. Write a check. Whatever feature you're using, it all happens behind the scene. So why do we need to learn anything about debits and credits? 2 reasons. 1, we all make mistakes, including Lamia. While I'm teaching class, I'm making mistakes. I get in a hurry, I make a mistake. I don't like bookkeeping. I don't want to be the one that's doing the data entries. So I make mistakes. That's why I have the secretary do it. And they make mistakes. My CPA makes mistakes. I outsource the payroll. I get a notice from the IRS. There's an error. Okay? I have to then go in my books and fix the error. You cannot fix an error if you don't understand debits and credits. Not possible. So if you're going to do it at all, you have to know how this works. So, and the adjusting entries too. There are adjusting entries that are necessary. Some people pay their CPA to do the adjusting entries for you. If you've got a lot of money, you don't have to worry about it at all. You can just hire everything out. Well, I don't know about you all, but in small business, I didn't have a lot of money. I had to do things, wear all the hats, including bookkeeper. So, it's real simple. The categories in all accounts are simply assets and expenses, which are debit accounts, liabilities and capital, capital means the ownership accounts, and revenue. Liabilities, capital, and revenue are credit accounts. Assets and expenses are debit accounts. And what that simply means is the normal balance in all assets, your cash account, your equipment, everything that's an asset, accounts receivable, the normal balance is a debit balance. In the expense accounts, the normal balance is a debit balance. And the same thing is true with all the credit accounts. The normal balance is credit balance. And there are no other categories. So, and rule number 1 says that all accounts appear under a column. They're under a column. They're debit accounts or credit accounts. Okay? Just like I said. And there they are with the credit accounts. And there's the other income and other income accounts, all under the same heading. There's only 2 headings, debit or credit. So expenses are all debit accounts. And rule number 1, this is the key. Very simple. To increase the balance of an account, you do the same as its column name. To increase the balance in a debit account, you debit it. To increase the balance in a credit account, you credit it. To decrease the balance, you do the opposite. the opposite of its column name. To decrease the balance in your cash account, you credit it. And you go, wait a minute, the bank says I've credited your account and the balance is increasing. No, that's from the bank's bookkeeping side. Credit in your checking account when you're posting decreases the balance. The opposite of what you think it's going to do. Okay? So there's the key to the whole thing. Once you know which accounts are involved and in which direction they're going, you're done. Debits and credits are that easy. I had a client that had the accountant send to her an adjusting entry. And she had no idea how to enter it in the general journal of the QuickBooks. So, and I happened to be there on a session for small business counseling like I do on site. And I showed her this. She understood it and entered the transaction that she was given. Now, each transaction must have equal debits with credits. They have to balance. Double entry bookkeeping system, which was set up by an Italian many, many years ago. I forgot his name. But it was an Italian that set up this double entry. Always debits and credits at the end in one transaction has to equal. Equal debits with equal credits, dollar-wise amount. Debits and credits don't mean plus and minus. I'd already said that. They can increase or decrease depending on the accounts. And rule number 4, the general rules of direction are real simple. This is amazing. In my accounting classes, I talk to students and I say, when you're recording an expense, is the balance increasing or decreasing? And I have some of them say decreasing because you're spending money. I said, no. When you're keeping a record of how much you've spent throughout the year, the balance in your expense accounts on your books is increasing. Just like how much you're earning in income throughout the year. The balance is increasing, not decreasing, okay? So you have to understand which direction the balance is going in. Now, the normal accounts, the contra accounts have the opposite balance as the normal ones. So, for an example, when you have, say, sales discounts you give to a customer, the sales discount account, and you can see it on my form, is a credit account, just as the account called sales. But the balance is called a contra balance, meaning the normal balance in the sales discount is a debit balance. And a debit balance is going to decrease. And so therefore, sales discount starts out at the beginning of the year with a 0 balance. And it gets into, as you post discounts, it decreases to an ever larger negative number. Contra accounts have a negative balance. Okay? The balance is decreasing. And then the nominal accounts, income, expenses, net income, are all closed at year end. So what happens, you have 2 financial statements that are most important. A balance sheet and an income statement. That's all I need as a small business. You got all the journals and ledgers and so on. That's mostly used just for finding errors and correcting them. You do need those. But the ones I watch during the year, I don't need a cash flow analysis. I don't need any of that. I got a balance sheet month after month after month. If my cash balance is increasing, I'm smiling. If my cash balance is decreasing month after month, I got to look and see what I can do to fix that. It's just that simple. I don't need somebody to give me a fancy method of doing cash flow analyses. I've got spreadsheets that are amazing to do that, but don't need it. Keep it simple. That's all you need. So this way is the fastest, easiest way to learn and most retentive way. In other words, you have the form. All you got to do is look at it. Anytime you're doing a transaction, you use that a few times, and you're doing it in a normal, posting each month, which I recommend, by the way, for small businesses. It's okay to do your books each month, or you could wait till year end and just put it all on one spreadsheet. if you really want to keep it simple. And that can be done. But in any event, typically the monthly posting is the typical way of doing it. And at the end of each month, you print your balance sheet, an income statement. You got month after month after month, and you can very clearly see how you're doing. That's the best way. Again, point number 2 there is all you have to do is practice. You do need some training maybe in terms of which accounts are involved and are they increasing or decreasing. So here's an example. This is purchasing items on account. You enter a bill on the QuickBooks, you don't see the debits and credits. And most textbooks will rarely even mention what the debits and credits are. Some do and some don't, but none of them do it my way. In my textbooks, in my teaching aids, I always show the arrows. And I connect up the arrows with what's happening in the transaction. That's how you learn it. So for an example, you enter a bill. You buy an asset or you pay for an expense. Assets are debit accounts, expenses are debit accounts. The balance is increasing, so you debit it. And then, because you bought on account, you owe money. That's a liability account, and as you can see, liability accounts are credit accounts. So you credit it, and the balance is increasing. So by my teaching method, with my teaching aids, you can see clearly in which direction they're going, and that's going to stick in your mind, and you're going to understand how to do it. A bill for purchase of supplies, that's all you do. Increasing office supplies expense, increasing accounts payable as a credit. Let's see, there's one here. I like this one. This one here. Create an invoice to a customer. You create an invoice in QuickBooks, all the debits and credits are behind the scene. You make a mistake, how are you going to fix it? You can't if you don't know how it works. So you've got a sales for $100. The sales tax is $8.25. That's what we have in Winnebago County. And it's different in all the different counties, by the way. So accounts receivable, the customer owes not only what they paid for, but also the sales tax on it, right? So the invoice is $108.25. $100 for the product that they purchased, whatever it is, the sale, and sales tax payable. Why? Because at the end of the month, you have to pay the state the sales tax that you have collected from the customer. So bookkeeping is not that hard. It's really not. When you take the mystery out of it, it's not hard. And this is receive a payment on account from the customer. You click on receive payment, and it's real easy to post. Your accounts receivable is decreasing because now they no longer owe it to you. And your cash is increasing because you put the money in the cash drawer. You see what I'm saying? So all of these are that simple. So the training is in knowing which accounts are involved and in which direction they're going. Then you look at that sheet and you got it. And when you make an error and you need to do a correcting entry or you need to do an adjusting entry at the end of the month, some people want to post their inventory change at the end of the month if they're not tracking the inventory on the computer. Then you can do an adjusting entry. There are many reasons for adjusting entries besides correcting errors. You'll notice that I've got on there, it says for use with perpetual inventory. Perpetual inventory is for companies that track each and every individual inventory item on QuickBooks. And so therefore, when they buy it, they post it on QuickBooks and they show the cost. When they sell it by way of an invoice or a sales receipt, then it automatically comes out of inventory. It's perpetual. You don't have to make adjusting entries. For those of us who don't want to do that, and we have a lot of products and we don't want to post them all on QuickBooks because it takes a lot of time, we can do adjusting entries for periodic inventory, which is a separate sheet than that one. It's just the cost of goods sold accounts are slightly different. So I'm running out of time. Payroll, I'm not going to teach payroll today. But the bottom line is I created forms that show all of the different taxes in a particular way so that when you're doing your, see that 13, 24, 32 down there? When you're doing your 941, it separates out all the taxes for the federal and the separate taxes for the state. So it's real easy to figure out. And I teach payroll. I'm going to teach it this month at Rock Valley College and at Belvedere North High School. So, and there's a breakout of the 941 liability. That's the way I laid it out. It keeps it simple. So everybody knows about unemployment comp. You got one or more employees, you know about Illinois Department of Employment Security, right? So I also have a way of teaching how that's calculated, okay? And this is that's the general journal entry of one paycheck that keeps track of all of the different taxes and so on. This is all part of my payroll forms. And then I talk about the payroll services from Intuit and the different services that Intuit provides. They're the ones that do QuickBooks. The full service. They actually guarantee that they'll do all of the forms for you and make the payments on time. But guess what? As an employee, even though they're all done for you, even though you have outside service, guess what? You still are liable as a business owner for the taxes. Even if you pay for somebody to do the services for you, they make a mistake, you're the one who's liable. And this is just what the home page looks like on QuickBooks. There's what the home page looks like on QuickBooks Online. And so I have a class taught at Rock Valley, which you can just go onto the Rock Valley webpage and sign up for them. If you can't go to the class, I do have teaching aids for desktop or online. And let's see, this is to register for that. Those are my publications. And I do on-site training through Bernie Lukey at Rock Valley College. QuickBooks, online, desktop, Excel training, even Word forms. And I want to thank Jason, and you guys do an amazing job here. I think it's wonderful, and I was hoping that you could explain what you do more. That's what I wanted to say here now, and thank you for it. So
that's a different presentation.
Ready for questions, right?
All right, well, let's give